Good morning. Freddie Mac's 2026 multifamily expansion and why Houston is emerging as a power market. And the Federal Housing Finance Agency, or FHFA, has made a decision to increase 26 multifamily loan purchase caps up to 88 billion, which it was at 73 last year. So it expands the agency's liquidity. But the real story isn't just about the size of the capital pool. It's about where that capital is most likely to flow. And when you analyze Freddie Mac's portfolio concentration strategy, one metro stands out. And Freddie Mac is signaling that Houston is the core agency market for them and not a secondary Sunbelt market. So let's talk about Freddie Mac's concentration strategy. And Freddie Mac's largest multifamily holdings are concentrated in five major metros. Number one is New York, Newark, Jersey City with 39 billion, but there's also Dallas, Fort Worth, Arlington with 21 billion, and LA, Long Beach, Anaheim with 20.8 billion. Washington, Arlington, Alexandria with 18.5 billion. But also leading up the list is Houston, the Woodlands, and Sugarland at 17.3 billion. And that puts Houston at rank of fifth nationally in Freddie Mac's total multifamily loan exposure, which is ahead of numerous coastal markets typically highlighted in headlines. And that positioning is deliberate. Freddie's capital allocation reflects underwriting compatibility, liquidity depth, refinance velocity, and sponsor concentration. And the point is that Houston checks a lot of the boxes for a lot of folks. So why Houston fits Freddie Mac's model is our next little segment. And Freddie Mac's multifamily portfolio historically emphasizes they're looking for institutional and repeat sponsors, but also garden style and large format suburban communities. And they're okay with high refinancing turnover. And they have scalable development pipelines. But they also like markets with transaction liquidity. And Houston aligns structurally with each of these criteria is the point. So let's talk about them in a little more detail. So institutional sponsor base. Houston hosts a deep bench of regional and national operators capable of executing agency scale transactions. Two is garden style dominance. And unlike dense urban core markets, Houston's suburban development pattern favors stabilized, agency-friendly product types. Number three is refinance velocity. So large format Class A and Class B properties built during 2020 to 23 cycle will likely enter refinance windows out if in 26 or if not in 27. And that's directly aligning with Freddie's expanded cap. Four is economic depth. Houston's economy spans multiple industries. Energy is what we're known for, but also healthcare and cancer research, logistics, and port activity, but also advanced manufacturing. And we have some emerging tech corridors with the Tesla plant out in Brookshire. That diversification supports renter absorption and it mitigates a lot of cyclical volatility. So let's talk about the big five markets versus strategic depth. Now, while coastal markets dominate total securitized GSE volume, there's strategic differentiation there is emerging. And Fannie Mae maintains heavier exposure in coastal and urban core environments, but Freddie Mac leans more into high-scale Sunbelt metros where suburban product and sponsor scale intersect. And Houston represents the clearest example of that bias. And this is not about growth headlines. It's about underwriting compatibility. So let's look at some strategic implications for 2026 investors. With expanded agency caps, several realities emerge. One is liquidity depth. Freddie execution in Houston should remain competitive for stabilized multifamily assets. Two is suburban product strength. So Class A and B garden style communities remain highly executable. Three is refinance pipeline acceleration. Loans originated in 22 to 23 are going to face maturity and rate resets, which should create refinance volume. 4 is sponsor advantage. Institutional operators in Houston may receive stronger agency appetite relative to smaller tertiary markets. And for investors, structure will matter more than ever, as will debt yield thresholds and potential interest only structures, but also rate cap strategy and prepayment flexibility, but also sponsor track record. Houston offers scale, and Freddie offers liquidity, and that intersection is strategic. So here's the bottom line. The 2026 cap increase by the agencies basically is going to expand the capital pool available for multifamily assets. But capital flows towards structurally aligned markets, which is Houston. And Freddie Mac's portfolio positioning makes one thing clear, that Houston is not just a Sunbelt growth story, it's a core agency market. And for sponsors, investors, and capital advisors operating in Houston, understanding Freddie's preference or underwriting preferences will determine who captures liquidity and who's going to miss execution windows. And if you operate in Houston multifamily, this cycle will reward discipline and structure. That, my friends, is it for the day. Please visit my website, HoustonRealEstateBrokerage.com. You can figure out how to get a hold of me. Love to talk to you more. Take care.